Ordinary, can you see 100 million? Remember we said that the authorized share capital in note number 1 was 100 million. 100 million. And in note number 8, examiner says that we issued everything. Note number 8, examiner said a lower limited issued for cash and at par value the remaining ordinary shares. Therefore, in note number 1, the ordinary shares were 100. In note number 8, we issued everything. Therefore, here in the balance sheet, ordinary share is 100,000. Then do we have anything else? We have non-current liabilities. Non-current liabilities. Under non-current liabilities, we paid the bank loan, therefore do not appear in our balance sheet. We go just to current liabilities. Non-current liability, we took over the loan. Listen very carefully. We took over the loan of 22,500, but when you check in our bank account, we paid that loan. We paid off that loan. Therefore, we do not go to our balance sheet. Here we have, we took over payables. We took over payables, which was 59. Then also we took over tax payable. Tax payable, which is 3,000. Then I believe we are done. You give me total equity and liabilities. Total equity and liabilities. So that we go to the next question quickly and we understand the concept. Quickly, the balancing figure, do it quickly. My good friends, do it quickly. Do it quickly so that we go to the next question. Okay, we go to the next question. 108,900. Edwin, thank you very much. 108,900. What about the capital? Is it the same? Thank you very much, Edwin. Now we want to go to the next question of the same topic, external reconstruction, so that we see if we can understand this concept. December 2022. Let's look at December 2022. Question number 5. December 2022, question number 5. December 2022, question number 5. Are you there? December 2022, question number 5. Are you there? December 2022. It seems nobody is there. Let's wait. I can see Ruth, you say you are there. Let's continue. It is good to respond because teaching online is not easy. I don't know what you are doing over there. Therefore, it's not that easy. It's good to also help Mwalimu know that we are together. Okay, this question says, Dahiti Limited, a private limited company, has been in financial difficulties and has reported trading losses for a number of years. The directors of the company invited the shareholders and the creditors for a special general meeting where it was resolved that operations of Dahiti Limited be transferred to the newly formed company Stawi Limited, with effect from 1st August 2022. The latest statement of financial position of Dahiti Limited as at that 1st July 2022 was as follows. We have the balance sheet, of which we call it the book values, property, plant and equipment, intangible assets, that is plants, inventories, accounts receivable, ordinary share capital of shillings 10 each, 10% redeemable preference shares of shillings 10 each, share premium, retained earnings, 12% bond, accounts payable, accrued interest on bonds, bank overdraft, and total equity and liabilities. Additional information. The newly formed company's authorized share capital comprised 5 million ordinary shares of shillings 10 per value. That is the authorized share capital of this company. Number 2, Stawi Limited issued 4 new ordinary shares of shillings 10 each, credited at shillings 5 each for every 2 preference shares held in Dahiti Limited. The preference shareholders agreed to immediately pay the balance on the shares allotted. Number 3, preference dividend in Dahiti Limited were 2 years in arrears. Half of the preference dividend in arrears were settled by issue of fully paid ordinary shares of shillings 10 each in Stawi Limited. Number 4, the new company also issued 3 new ordinary shares of shillings 10 each, credited at shillings 5 each for every 5 ordinary shares held in Dahiti Limited. The ordinary shareholders agreed to immediately pay the balance on the shares allotted. Number 5, the bondholders in Dahiti Limited agreed to be transferred to the new company on condition that the bonds will be convertible into ordinary shares after 3 years. The coupon interest rate for the convertible bonds was to be 8% per annum. Similar bonds with no conversion rights attracted interest rate at the rate of 10% per annum. Accrued interest on the bonds was to be paid immediately upon taking over. Number 6, the current liabilities of Dahiti Limited were transferred to Stawi Limited at their book values. Number 7, the brand was considered valueless and therefore written off. Number 8, the tangible assets were taken over by Stawi Limited at their fair values as follows: property, plant and equipment, inventories, then accounts receivable. Number 9, liquidation expenses of Dahiti Limited amounted to 6 million and were settled by Stawi Limited. Number 10, immediately upon takeover, Stawi Limited invited its ordinary shareholders for a 1-for-5 rights issue of ordinary shares at an exercise price of shillings 5. The average market price of the ordinary shares on come right basis immediately before the rights issue was 20. The issue was fully subscribed. Required the following ledger account to close the books of Dahiti Limited. Number A, realization account, preference shareholder sundry members account, ordinary shareholder sundry members account. Number B, journal entries in the books of Stawi Limited to record the initial recognition of 80% convertible bonds and rights issue on 1st August 2022, then the opening financial statement of Starry Limited as at 1st August 2022. Therefore, this is also this external reconstruction question. And as we said, that in an external reconstruction, you are going to close the books of the selling company, then you open the books of the purchasing company. What are the books of the selling company? We did mention that we have realization account, we have assets and liabilities account, purchasing company account, then shareholder sundry members account, shareholder sundry members account. Those are some of the books of the selling company. Therefore, in this question, examiner has told us that we prepare number A, we do the ledger accounts to close the books of Tanga Limited, Tanga or Dahidi, to close the books of Dahidi Limited. Dahidi Limited. Ledger accounts to close the books of Dahidi Limited. Now we ask ourselves, what are these books of Dahidi Limited? Are we going to close? Number one is the realization account. Realization account. This one now you are leaving this realization account, you can give it like 8 lines going down. Then we have ordinary shareholder. Shareholder, sundry members. You can give it like 4 lines going down or 5. Then we have preference shareholder, sundry members. Preference shareholder, sundry members. You can give it like 3 lines going down, 3 lines going down. You give it like 3 lines going down. Then in the ordinary, you bring down the balance. Balance brought down. Balance brought down, you get it from the balance sheet, which is 20,000. Also, share premium belongs to ordinary shareholder. Share premium, which is how much? 2,000. Share premium belongs to ordinary shareholder. Therefore, you bring it down. Then we have in the preference balance brought down, which is 10,000. 10,000 like that. 10,000. 10,000. Then we prepare what we call purchasing company account. Also, we have the company called purchasing company account. Purchasing company account, which in this case, you give it 7 lines, and we call it Starry. We call it Starry Limited. This is our purchasing company account. We call it Starry Limited. Those are the ledger accounts we are going to prepare to close the books of Dahidi Limited. Now, when we come to close the books, remember I gave you journal entries on how to close the books. Number 1 was with the assets that was transferred. The assets that was taken over, you debit realization, you credit asset account. Number 2 was the assets not taken over, you debit ordinary shareholders and members, you credit asset account. Number 3 was with the liabilities taken over. Therefore, we are going to go in that order. We are just going to go in that order. Therefore, in this question, we say with the assets that were taken over, we debit realization. How do you know that the assets was taken over? You check in the fair value, like in this question, note number 8. The tangible assets were taken over by Star Limited at the following values. Therefore, these are the assets that were taken over. These were the assets, but the values we take what is the balance sheet. Therefore, I would say PPE. PPE was taken over. Inventory was taken over. Receivable was taken over. But the balances, we take what is in the balance sheet. Like this one, that 1,750. That 1,750 for 310. Then lastly, we have that 840. That 840. Those were the assets that were taken over. Then an asset that was not taken over, we take it to ordinary shareholder. How do you know that the asset was not taken over? The asset is in the balance sheet, but it is not in the fair value. That asset was not taken over. Like when I check in the balance sheet, I have brands. And this brands is not in the fair value, 4,800. It means it was not taken over. Thereby, I account for it like that. That is journal entry number 2. Journal entry number 3, we say that with the liabilities taken over, we debit liability account, we credit realization with the liabilities that were taken over. What do? We are going to credit realization. Therefore, the liabilities that were taken over, we have 12% bonds. 12% bond, 12,500. It was taken over. Then we have payables. It was taken over. Payables, 3090. Then accrued interest. We have 750. Then lastly, we have bank OD. Bank OD, which is 2250. 2250. These were the liabilities that were taken over. You credit realization account. Then, good friends, we go to note number 4 in our journal entries. We talked about the purchase consideration. Purchase consideration, we said we debit purchasing company account, we credit realization. But in this case, we don't have it. Therefore, we jump note number 4. It will go hand in hand with note number 8 in our journal entries. Note number 8 was with the compensation made to the shareholders of the selling company. With the compensation made to the shareholders of the selling company, what do? We are going to debit shareholder, we credit purchasing company, note number 8. Therefore, note number 4 and note number 8 will go hand in hand. Therefore, let's jump note number 4. We go to note number 5. Note number 5, we say, with the accumulated loss written off, you debit ordinary shareholder, you credit P&L. Therefore, when I check in the balance sheet, there is a accumulated loss. Accumulated loss of how much? Of 5890. 5890 like that. I debit this account, I credit P&L. Then after I have accounted for the accumulated loss, I go to note number 6. Note number 6 said, with the preference dividend in arrears. Preference dividend in arrears. What do I do with it? With preference dividend in arrears, I debit realization, I credit preference shareholder. Therefore, in this question, when you go to note number 3, examiner says, preference dividend in Tahiti Limited were 2 years in arrears. The preference dividend was 2 years in arrears. How do I get preference dividend? Percentage times preference share capital. Percentage times preference share capital. Therefore, that is how I get. How much is the percentage of preference? How much is the percentage of preference? It is 10% times how much is the capital? 10,000. And it was how many years in arrears? 2 years in arrears, of which I'm going, where did you get accumulated loss? Check retained earnings in the balance sheet. Florence, check the retained earnings in the balance sheet. Retained earnings in the balance sheet, then you will answer that question yourself. Retained earnings in the balance sheet. Therefore, preference dividend, it was 2 years in arrears. How do we get it? You take the percentage times preference share capital. That is 0.1 times 10, which is 2,000. Preference dividend in arrears was 2,000. Where do I take it? I debit realization. I say dividend in arrears, 2,000. I credit preference. I say dividend on preference. Shareholders and members, 2,000. That is what we said about note number 6 with preference dividend in arrears. That is in our journal entries with preference dividend in arrears in note number 6. Then we go to note number 7 in our journal entries. I'm using that journal entries because they are the ones that will help you understand this question, the procedure very well, if you use those journal entries. Note number 7, we said, with the liquidation expenses, you debit realization, you credit purchasing company. With the liquidation expenses, you debit realization, you credit purchasing what? Company account. When I check in this question, I'm referring to this question. Note number 9, it says, liquidation expenses of Dahili Limited amounted to 6 million and were settled by Stawi Limited. Therefore, I'm going to say here liquidation, which is 6 million. I credit Stawi Limited. I say liquidation, 6 million like that, 6 million like that. I have accounted for the liquidation expenses. Any question, put it in the chat. Like, I like my good friend Florence very much. Although he never responds to Mwalimu, but he asks Mwalimu questions, and she wants Mwalimu to respond to her questions. But when Mwalimu asks something, she doesn't respond. But I know we shall overcome. When we shall overcome. Imagine, Florence, you ask Mwalimu, Mwalimu does not respond. How do you feel? You ask Mwalimu a question, Mwalimu does not respond. You ask again, Mwalimu does not respond. How can you feel? Like now, Mwalimu asks you something, you don't respond. Okay. Now let's continue. Now, in our journal entries, when you go to note number 8 in our journal entries, when you go to note number 8, we talked about the compensation. And we said, with the compensation made to the shareholders of the selling company, how do you account for it? You debit the shareholder, you credit the purchasing company, in this case, Stawi Limited. With the compensation made to the shareholders of the selling company, how do you account for it? You debit shareholder, then you credit the purchasing company. Now, in this question, when we go to note number 1, let's together read note number 1, additional information note number 1. Examiner said like this: the newly formed company's authorized share capital comprised 5 million ordinary shares of 10 each. That is not the compensation. Examiner is giving us the authorized share capital. I believe in our previous class, I explained what is the authorized share capital, which I said is the capital that the company will register. That in my lifetime, I want to have 5 million shares. I want to have 5 million shares of shillings 10, which comes to 50,000. or 50 million, that is my capital I can have in my lifetime. Then that is the authorized share capital. Then number 2, Starway Limited issued 4 new ordinary shares of shillings 10 each, graded at shillings 5 each, for every 2 preference shares held in Tahiti Limited. The preference shareholders agreed to immediately pay the balance on the shares allotted. Now, when you read note number 2, examiner is compensating preference shareholder. When you read number 2, examiner is compensating compensation to preference, compensation to preference shareholder, compensation to preference shareholder. In note number 2, how are we compensating preference shareholder? We are giving them ordinary shares. We are giving them ordinary shares. We are giving them ordinary shares. How are we giving ordinary shares? How are we giving ordinary shares? Examiner says, Starway Limited issued 4 new ordinary shares of shillings 10 each, graded at shillings 5 each, for every 2 preference shares held in Tahiti. Then what the examiner is saying, if you have 2 preference shares, I'm going to give you 4 ordinary shares. Listen to what Malim is saying. Florence, you say you always listen to Malim. Therefore, I want you to listen to this one. Examiner is saying, for every 2 preference shares, you will get 4 ordinary shares. Therefore, what about 10,000? 10,000 preference divided by 10, which makes it 1,000 preference shares. What about 10,000? 10,000 is the capital of preference shareholders from the balance sheet. 10,000 is in shillings, then we convert it into ordinary shares, where we get 1,000 ordinary share. Therefore, this one will be 1,000 times 4 divided by 2. You divide by 2. Therefore, how many ordinary shares are we issuing? How many ordinary shares are we issuing there? The ordinary shares is 2,000. 2,000. Those are the ordinary shares that we are issuing. But we are giving these ordinary shares at shillings 5. The ordinary shares are being issued at shillings what? 5. The ordinary shares are being issued at shillings 5. Therefore, it will be 2,000 times 5, which gives us 10,000. 10,000. 10,000. Therefore, purchase consideration to preference shareholder is 10,000. But remember, these shares are not fully paid, are only paid to the tune of shillings 5. They are only paid to the tune of shillings 5. Therefore, when we open the books of the purchasing company, when we open the books of Starway Limited, the shareholders will add another 5 shillings per share, which means they will add another 10. We shall save from them so that we make their shares fully paid. But for now, the purchase consideration is 10,000. The purchase consideration is 10,000. Therefore, we debit preference shareholder. Debit preference shareholder, you say compensation. Compensation, 10,000. Compensation, 10,000. Who is compensating? Starway Limited purchasing company, we say preference. He has compensated preference shareholder 10,000. We have compensated preference shareholder 10,000. 10,000 there. We have compensated preference shareholder 10,000 there. Then, after we have compensated preference shareholder 10,000, we go to note number 3. What does note number 3 say? Note number 3 says, preference dividends in Tahiti Limited were 2 years in arrears. Already we accounted for that dividend. But have we compensated it? No, we have not compensated that preference. We just accounted on recognition. Examiner says, preference dividend in Tahiti Limited were 2 years in arrears. Half of the preference dividend in arrears was settled by issue of ordinary shares of shillings 10 each in Stawi Limited. Therefore, remember, preference dividend was 2,000. It was 2,000. Preference dividend was 2,000. If you remember very well how I calculated, I believe you remember, it was 2,000. But we compensated half by issue of ordinary shares. Therefore, it means we issued shares of 1,000. Therefore, this 1,000, we are compensating who? Let me pause a bit. Let me pause. Let me pause. This 1,000, we are compensating who? We are compensating for preference dividend. Preference dividend belongs to who? To preference shareholder. Therefore, it means I'm going to compensate preference shareholder. Therefore, in my preference shareholder, I say compensation. 1,000. I say compensation. 1,000. Who is compensating? Stawi Limited. I say he has compensated dividend 1,000 like that. 1,000 like that. He has compensated dividend 1,000 like that. Yes, that is how we have compensated preference dividend. Preference dividend. Then we go to the next note. If you have any question, kindly put it in the chat. Marine will respond. Any question, just put in the chat, or you can speak. You can speak. I have not muted you. You just muted yourself. Therefore, you just speak. Florence, if you have any question, just speak. Marine will listen to it very carefully. Note number 4. Note number 4. The new company also issued 3 new ordinary shares of shillings 10 each, created at shillings 5 each for every 5 ordinary shares held in Tahiti Limited. The ordinary shareholders agreed to immediately pay the balance on the shares allotted. On the shares allotted. On the shares allotted. On the shares allotted. Then when we read note number 4, it is compensation. Note number 4, compensation to ordinary shareholder. Compensation to ordinary shareholder. Note number 4, we are compensating ordinary shareholder. How are we compensating? We are giving him ordinary shares. Ordinary shares. We are giving him ordinary shares. If you read that note, we are compensating ordinary shareholder. What are we giving him? Ordinary shares. How are we giving him? Examiner says 3 new ordinary shares of shillings 10 each, created at shillings 5, 5 ordinary shares each for every 5. Therefore, if you have 5 ordinary shares, I'm going to give you 3 new ones. If you have 5 ordinary shares, I'm going to give you 3. Then what about 20,000 divided by 10, which is 2,000? What about 2,000? What will you get if you have 2,000? There you will get, that is 2,000 times 3 divided by 5. Divided by 5. Divided by 5, that is 2,000 times 3 divided by 5. 1,200. 1,200 like that. 1,200 shares. It was given at which price? It was given at shillings 5. Therefore, it will be 1,200 times 5, which is 6,000. 6,000. But remember, these shares are not fully paid. When we go to the other side, when we cross over, the moment we cross over, we are going to add again shillings 5 to make our shares fully paid. When the moment we cross over, we are going to add another shillings 5, which means we shall add the same amount of 6,000 to make our shares fully paid. Therefore, this was a compensation to ordinary shareholder. It was a compensation to ordinary shareholder. Therefore, I debit ordinary shareholder, I say compensation. Compensation, ordinary shareholder, compensation, 6,000. We have compensated him 6,000 like that. We have compensated ordinary shareholder in note number 2, note number 4, sorry. Then we go to note number 5. Note number 5 says, the bondholders in Tahiti Limited agreed to be transferred to the new company on condition that the bonds will be convertible into ordinary shares after 3 years. The coupon interest rate for the convertible bonds was to be 8% per annum. Similar bonds with no conversion rights attracted interest at the rate of 10% per annum. Accrued interest on the bonds was to be paid immediately upon taking over. Now, listen to note number 5. Listen to note number 5 in this question. Listen very carefully. Listen, what the examiner is saying there is that after we have taken over this company, there was a loan. Now, this loan will be converted into ordinary shares. This loan will be converted into ordinary shares. This loan will be converted into ordinary shares. Therefore, if this loan will be converted into ordinary shares, then we are going to handle it as a compound financial instrument. A compound financial instrument, or the embedded derivative. You remember, when we were doing financial instruments, we did a subtopic there of embedded derivative or compound financial instrument, where we said that a compound financial instrument is an instrument that has two components. It has the equity element and it has the liability. Therefore, you are required to separate the two and account for them separately. Therefore, when you read this, it's a compound financial instrument. Therefore, the moment we take over, we are going to account it the moment we take over. That is when we are going to account for note number 5, the moment we take over this company, then we separate that compound financial instrument. Note number 6. Let's go to note number 6. The current liabilities of Tahiti Limited were transferred to Starwi Limited at their book values. That one already we accounted for. We already transferred the current liabilities. Therefore, that has no issue. We already transferred the current liabilities. Number 7. The branch was considered valueless and therefore written off. That was considered valueless. Therefore, we say that with the assets that were not transferred, you debit ordinary shareholder. Already we did that. Assets that were not transferred. Then note number 8, the tangible assets were taken over by Starwi Limited at the fair values as follows. Already we accounted for that. Already we accounted for the assets that we transferred. Although the values we are taking, the book values, that is what Mwalimu recommended. Then note number 9, liquidation expenses of Tahiti Limited amounted to 6 million and were paid by Starwi Limited. Already we accounted for the liquidation expenses where we say you debit realization, you credit purchasing company account. Then we go to the next, where we say the next is number 10. Immediately upon the takeover, Star Limited invited its ordinary shareholders for a 1-for-5 rights issue of ordinary shares at an exercise price of shillings 15. The average market price of the ordinary shares on cap right basis immediately before the rights issue was shillings 20. The issue was fully subscribed. That one we shall account for it when we cross over. That is when Star Limited is going to do a rights issue. Therefore, the moment we cross over, then we do the rights issue. We do the rights issue there. Therefore, we can now close the books. We can now close the books. But before we close the books, here we have not transferred the ordinary. In the ordinary. We debited this for the compensation to ordinary. We debited ordinary shareholder. We credited purchasing company. We have not done it. We have not credited purchasing company. Sorry for that. Compensation to ordinary. Compensation to ordinary. You debit ordinary shareholder. You credit purchasing company. We have not credited purchasing company. Now we are done with this. You give me totals. You give me totals.
Madam, I have a question.
Yes, just ask.
On note number 3.
Note number?
Note number 3.
Yes.
The preference, half of the preference dividends in arrears settled
Yes.
by issue of fully paid ordinary shares. We calculated half the preference shares to be 1,000. Why didn't we multiply with these 10 shillings?
That was dividend in arrears. It was dividend in arrears. Remember, when we calculated dividend in arrears, it was 10% times 10,000, of which 10,000 is in shillings, is already in shillings. Therefore, whatever we are going to get times 2, 2 is the years. Or first, let's get what was the dividend per year. Per year, it was 1,000. Per year, it was 1,000. But remember, that one is in shillings. We have not converted into shares. It is in shillings. Therefore, we just multiply by 2 to get how much? It was 2,000. But remember, this 2,000 is in shillings, not in shares. We took the percentage times the shillings. Therefore, it is in shillings. That's why we do not multiply by shillings 10. That's why we do not multiply by 10, because when we multiply like this, it is already in shillings.
Okay, got it. Thank you. Yes, thank you.
Okay, welcome. Okay, now, after we have this, now we close the books. How much is our realization, total realization? Total realization, I will take 6 million plus 10,000 plus 1,000 plus 6,000, 23, we get 23. That is our total purchase consideration. Total purchase consideration. Total purchase consideration. Now, with this purchase consideration, when you go to note number 4 in our journal entries, if you have those journal entries, note number 4 closing the books, note number 4 closing the books, we said with purchase consideration, you debit purchasing company, you credit realization. Therefore, I say here purchase consideration or realization, sorry. I say here realization. Realization, which is 23. Then I credit realization. I say purchase consideration. Purchase consideration, which is 23. 23. I have accounted for the purchase consideration. I have accounted for the purchase consideration. Then after that, I come to close these books again. Now we say with the balancing figure on preference and debenture holder. The balancing figure on preference. The balancing figure on preference. You cross it to the realization. Therefore, it means I'm going to cross my preference shareholder, share capital. On my preference share capital, balance brought I have the balance of 1,000, of which I say realization. Realization, 1,000. The balancing figure is 1,000 in the preference. I take it to the realization, I say preference. Preference, 1,000. I close it there. Then the balancing figure on preference, I close it to ordinary. Therefore, let me quickly balance this account. Let me quickly balance this account. That is 12,500. I'm having ordinary 5310. 5310. Therefore, on my ordinary I debit, I say realization 5310. Then this account needs to balance. That is 22. That is 22. Therefore, we have closed the books. This account needs to balance. Ordinary needs to balance. Then we have closed the books. Ordinary needs to balance. Then we have closed the books. We have closed the books. Ordinary needs to balance. We have closed the books. Now we go to open. But before we go to open, let's have a break of just 5 minutes, kindly. 5 minutes break, so that we come and open the books after we have refreshed up. Thank you. Let's stay tuned as we open the books of Stawi Limited. Company, books of the purchasing company. Here we are going to take over the business. We are going to take over the business. And when you take over the business, you are taking over assets and what? And liabilities. Then you pay what we call purchase consideration. Let me repeat what I have just said. We are taking over the business. And when you are taking over the business, you are going to take over the asset, take over the liabilities, then you pay what we call the purchase consideration. Therefore, we say journal entries, journal entries, journal entries to record, journal entries to record, journal entries to record, journal entries in the books. Let's say journal entries in the books of Stawi Limited, of Stawi. Journal entries in the books of Stawi Limited. Number one, taking over assets. We are taking over assets. You are going to debit asset. In this case, you debit PPE, you debit asset, in this case PPE, you debit inventory, you debit receivable, then you credit business purchase. You credit business purchase with the takeover values, which is 29,200, that 870, that 640, that 640. Then total I'm getting that 6 and 7 10. Let me repeat. That 6, 7 10. That 6 7 10. You credit business purchase with this total, which is that 6 7 10. Then we say, we give a narration, we say being the recognition of assets, taken over from Dahiti Limited. Being the recognition of assets taken over from Dahiti Limited. Number 2, liabilities, we are assuming liabilities. With liabilities, you debit business purchase, then you credit liability, like we took over 12% bond. We took over 12% bond. We took over payable, accounts payable. We took over accrued interest. We took over bank overdraft. Values are just there, 12,500, 3090, 750, 2250. Total, you debit business purchase. Therefore, what will be our total? 12. $18,590. You debit with 18,590. Then you say being the recognition of liabilities. Being the recognition of liabilities assumed from Dahiti. Being the recognition of liabilities assumed from Dahiti Limited. Then number 3, purchase consideration. Purchase consideration. Remember, if you use our notes that we wrote, you enjoy doing this question very much. You don't struggle anything. But if you just want to do it in your own way, you will struggle a lot. Purchase consideration, we say you debit business purchase. You credit vendor. In this case, you credit Dahiti Limited. What was our purchase consideration? 23. Purchase consideration was 23,000. You debit business purchase, you credit vendor, that is Dahiti Limited or the selling company. Then you say narration. Narration is being recognition of purchase consideration on acquisition of Dahiti Limited. Being the recognition of purchase consideration on acquisition of Dahidi Limited, being the recognition of purchase consideration on acquisition of Dahidi Limited. Then we prepare a business purchase account. Business purchase account to see if we have goodwill or capital reserve. We prepare business purchase account to see if we have goodwill or capital reserve. We said with the assets taken over, you debit asset, you credit business purchase. Therefore, I would say here assets, which is that 6, 7, 10. With the liabilities assumed, you are going to debit business purchase, you credit liability. Thereby say here liability. 18,590. Then we said with business purchase consideration, you debit business purchase, you credit Dahidi. Thereby say here purchase consideration. Which is 23. Which is 23. Which is 23. Thereby determine is it goodwill or capital reserve? I believe my good friend Florence, this is where you got the problem. Therefore, the balancing figure in this account will either be goodwill or capital reserve. Let's see.
Mwalimu, I have a question.
Yes.
Who is the vendor here? It is Taidi.
Yes.
The business asset we are creating, it is for Sitiwa.
Yes.
Aya. Why are we taking, why are we debiting business purchase of 23 and we are not crediting the 23? Oh, this is a journal.
Business purchase. Repeat the question kindly.
Why have we debited the 23 that is purchase?
Yes.
And not crediting, because you see the business that we've opened, the account that we've opened, this is the business account for Sitiwa.
Remember, like when we talk of a business purchase, it's like the capital account. Are we together up to there?
Yes, I'm following.
Now, when you have your money capital and you purchase asset, of course, when you purchase asset, you debit asset account, then you are going to credit your capital account. You credit your capital account as you have invested this money. Are we together at that point?
Yes.
Now, this is our capital account, our business purchase account. Therefore, whatever we have as money, we are going to debit to buy assets. Therefore, we debit the asset, then we credit our capital account, that is the business purchase account. And when we incur liabilities, it means that you are going to credit liability account because you are increasing liability. And of course, now you debit your business purchase account. You debit your business purchase account because you are increasing the liabilities in the company.
Okay, fine.
Yes, thank you. Now, we check on our business purchase account and see if we have goodwill or capital reserve. I'm getting goodwill. I'm getting goodwill of 48,000. That is my goodwill. That is my goodwill. Then I give journal entry, debit, goodwill account, 48. I credit business, so I credit business purchase account. with 48. I debit goodwill account. I credit business purchase. As you can see, it's on debit credit side. Therefore, we credit business purchase account as we debit goodwill, as we debit goodwill. Then you say, being the recognition of goodwill, being the recognition of goodwill on acquisition of Dahidi Limited. Being the recognition of goodwill on acquisition of Dahidi Limited. That is what you say as our journal entry. Now we are done with that note. Now what I want us to do, what I want us to do is very serious now. Very, very serious. After we have done all those journal entries, examiner told us a very serious item in note number, when you read in this question, note number 10, immediately after takeover, Stamp Limited invited its ordinary shareholders for a 1-for-5 rights issue of ordinary shares at an exercise price of shillings 15. Therefore, we are going to do the total ordinary shares that issued. Total ordinary shares issued. Ordinary shares issued. Total ordinary shares issued. Total ordinary shares issued. We issued ordinary shares to preference shareholder. Preference shareholder, we issued shares, which was 10,000. If you take in your purchase, in your business purchase consideration, in your purchasing company account, we issued ordinary shares to preference shareholders, of which they want to add another money back, 10,000. If you remember very well, we issued 10,000 as purchase consideration, but it was not fully paid. They will add another money in our bank to make their shares fully paid, 10,000. Then on dividend, we issued 1,000. We compensated 1,000 dividend, ordinary share. Note number 2, number 3 in this question, 1,000. Then on ordinary share, on ordinary shares, we also issued 6 million as purchase consideration, compensation. Then they were to add money in our bank account, 6 million, to make their shares fully paid. Because it was credited as shillings 5, they were to pay another 5 to make it at 10. Therefore, these shares of shillings 10, when you add them together, you are going to get when you add them together, we get how much? Yes. Yes.
Sorry. Where did you get bank of 10,000?
See, these people are adding some money. Remember, we gave them shares. The par value was 10. Par value was 10. But we gave them at shillings 5. And they accepted to pay shillings 5 per share again to make their shares fully paid. That is why we are recognizing what we gave them. And now we add what they are giving us in the cash. They are remember, this one is not fully paid. It's only paid at shillings 5. Therefore, it will be at shillings 10. They are adding so that it becomes at shillings 10 per value. But when we come to preference, it was at shillings 10 dividend. Preference dividend was at shillings 10. Therefore, this one, we are not going to add anything in the bank because it was given at full per value. When we come to ordinary, we gave them at 5. Therefore, they are adding another 5 to make their shares fully paid. Therefore, total shares at shillings 10, we add, of which I'm saying 20,000 plus 12 plus 1, 33. There we have issued that 3. But that 3 is of shillings 10. Is of shillings 10 per value. That 3 is of shillings 10 per value. This one added, this one added, this was at shillings 10 already. It was at shillings 10 already. Therefore, they will not add anything in our bank account. Therefore, remember, we are going to create bank account. We are going to create bank account. We are going to create bank account. We say bank account. In this bank account, we are going to receive money from preference shareholders to make their shares fully paid. Thereby say preference have given me 10,000. Preference have given me 10,000. Ordinary shareholder have given me 6 to make their shares fully paid. I'm receiving money from them. And now, up to that point, examiner says that we are going to issue, to do what we call the rights issue. Rights issue. And in the rights issue, if you have 5 shares, I give you 1. We are basing on what we have issued, this one. If you have 5, I give you 1. What about 33,000 divided by 10, which is 3,300 shares? If you have 5 shares, I give you 1. What about that 300? I have divided by 10 because the bar value is 10. Then I say 33 times 1 divided by 5, of which I'm getting what? I'm getting 660 shares. I'm getting 660 shares. This 660, let me wait. This 660, I'm going to multiply by 15. Exercise price was 15. Therefore, times 15 equals to 9. That is what we are receiving from the shareholders. Therefore, this 9, I'm going to debit bank with 900. I credit ordinary shares with 600. Ask me where I'm getting 600. Remember, per value equals to 10. Listen very carefully there. Per value equals to 10. Exercise price is 15. Therefore, it means we issued these shares at a premium. We issued these shares at a premium. How much is the par value? Par value equals to 660 times 10 par value, which is 600. Premium, it will be 660 times 5, which is 3,300. Thereby I credit share premium. Share premium with that 300. Anything above the par value is a share premium. Anything above the par value is a share premium. Anything above the par value is a share premium. Therefore, in my bank account, I say rights issue. Rights issue is 999. That's the rights issue. Then because we have money in the bank, we are going to pay liquidation expenses. Liquidation 6 million. We are going to pay liquidation 6 million. We are going to pay bank OD, bank overdraft of 2250. We are going to pay interest. Examiner said we pay interest. We are going to pay interest of 750. Therefore, how much are we remaining with in the bank?
Hey, mwalimu. Mwalimu.
Yes, I'm listening.
My network had issues.
Or your network had issues.
Yes, mwalimu. So at the back, and you've written liquidation, bank, overdraft, 22, interests. It's okay. I understand about liquidation and bank overdraft. How about these interests?
Remember, in note number 5, examiner said that accrued interest on the bonds was to be paid immediately upon takeover. Therefore, according to the examiner, we are to pay it immediately. Therefore, we are paying it immediately. In note number 5, where we are going now. Have you seen it? Are we not?
Mwalimu, I have seen. Mwalimu, I have seen.
Okay. Okay, now we go to note number 5. Let's go to note number 5, where there's also some issues there. Note number 5, it says the bond holders in Dahid Limited agreed to be transferred to the new company on condition that the bonds will be convertible into ordinary shares after 3 years. The coupon interest rate on the convertible bonds was to be 8% per annum. Similar bonds with no conversion rights attracted interest at the rate of 10% per annum. Accrued interest on the bonds was to be paid immediately. Now, note 5. Note 5 talks about convertible instrument. Convertible instrument. Under convertible instrument, separate equity component, and the fair value and the liability. You are going to separate the equity component and the liability. Equity component and the liability. Now, how do I separate equity component? Equity component equals to, you take the fair value minus present value. If I want to get equity component, remember financial instrument, we did this item. In our financial instrument, we did this item, therefore we are just revisiting. Our equity component, we take the fair value minus the present value. Fair value equals to 12,500. That is the nominal value of this bond. 12,500, that is what we took over. present value, you discount cash flows. You discount cash flows. Present value, you discount what? Cash flows. Present value, you discount cash flows, but fair value is the nominal value of this fund. Therefore, if I want to discount cash flows, what are the cash flows to be discounted? Cash flow equals to nominal value, nominal rate, nominal value times coupon payment, times coupon payment. Cash flow, where do I get cash flow to discount? It will be nominal value times the coupon payment. Now let me discount. What is my coupon payment? It will be 12,500 times 8%. 12,500 times the 8%. Then I get the cash flow. You get the cash flow, which is 1,000. Our cash flow is 1,000. My cash flow is 1,000. Therefore, I will say here, cash flow. We are doing it for 3 years. Discount factor, which is 10%. Discount factor, which is 10%. Then I get the present value. I get the present value. I get the present value. Now, in year 1, my cash flow is 1,000. Discount factor at the rate of 10%. Examiner said interest rate in the market is 10%. Therefore, it will be 0.091. Here too, it will be 1,000. My discount factor is 0.8264. In year 3, it will be 13 to 500. 13,500. Discount factor is 0.75, 13. Then I just multiply. I'm getting 10, the last one, 143. Then I add. Florence will say, Mwalimu, how is 13,500? This is 13,500. Now remember in the last year, let me write here in the last year. Last year. That is the year of redemption. That is the year of redemption. Therefore, I'm required to pay 12,500. I'm required to pay 12,500 plus the normal 1,000. Normal 1,000, which will give me 13,500. In the last year, it's for 3 years. Therefore, in the last year, you are going to pay everything. What is my everything? I'm paying the nominal value plus the coupon payment, which makes that 13,500. When I multiply by the discount factor, I get 10,143. 10,143. I'm getting 11,878 as my present value. My present value is 11,878. My present value is 11,878. Then I get the equity component. I get the equity component. Now, equity component, that is the EC, equity component, equals to, we say fair value minus present value. Fair value is 12,500, present value is 11,878. You give me the equity component. Now, which interest are you saying? Which interest? You come clear, because if you say which interest, you come clear. As we move on, I'm getting 622. That is my equity. 750. 750 is in the balance sheet. 750 is in the balance sheet. It means you have not read the question. 750 is in the balance sheet. Therefore, if you don't have it, then you have not read the question. That is the problem, because sometimes people just copy notes without reading the question. When I say read, then you go to your own things so that you don't get the figures. That is the problem with online classes sometimes. When we are reading, you go and do your own things. When you come back, you ask, where is this coming from? Okay, that is now, according to note number 5, we have accounted for the convertible bond. We have separated, remember, we have separated the equity component and the liability. Now, this present value is our liability. Present value is our liability. The 622 is our equity component. This one is our liability. The present value forms our liability. Now, when we go to the balance sheet, we report this as a liability. We report this 622 as the equity component in our balance sheet. Therefore, quickly, let's do the balance sheet. Let's go to prepare the balance sheet so that we complete this question. Now that we have everything there, let's do the balance sheet. Now that we have everything.
Mwalimu.
Yes.
I'm just asking a simple question too.
Yes.
Equity, the equity instrument is comprising of equity and liability. So the equity that you've taken, is it this one for 20% bonds?
Now the equity component, remember we took over the liability, which was 12% bond. Are you in agreement?
Yes, exactly.
12% bond from the balance sheet, we took over. And when we took over, now we decided that we are going to convert it into ordinary shares in the next 3 years. Therefore, once you have a bond that is convertible, then from the beginning or from the inception, it has 2 components. It has the liability and it has what? The equity component. And according to IFRS 9, you are required to separate the 2 so that you account for them separately. Like this one, I have now the equity component I have separated from the liability. Present value is the liability. Now, when we go to the balance sheet, this one, we report it as a liability. This one, we got it as an equity component.
Understood, Mwalimu.
Thank you very much. Now, let's do the balance sheet. We say Starway Limited. Statement of financial position as at 1st August 2022. As at 1st August 2022. Shillings in thousands. We start with non-current assets. Under non-current assets, we have PPE, which is property, plant, and equipment. Assets, you just copy paste what you have in the fair value, nothing else, which is 29. Then goodwill. My goodwill was 48 in the business purchase account. Then I go to current assets. Inventory. You just take that 870. Receivable. And remember, tomorrow we are beginning on group accounts. Tomorrow agenda is group accounts. Therefore, don't miss at whatever cost. Group accounts is tomorrow. We are beginning on group accounts, and in group accounts, introduction is the most important. Introduction is the most important. Therefore, tomorrow we are beginning on group accounts. Therefore, make sure that you concentrate very well.
Then Mwalimu, start those classes at 5:30 so that at least I catch up.
Because of the schedule, because other classes are there from 7. And remember, we need 2 hours. Our class needs 2 hours. It will have some challenges there. This bank balance, we got it from our bank account. From our bank account. From our bank account. This bank balance, then you give me total assets. Total assets. Then we go to capital and reserves. Ordinary share capital, 33 plus 66, which is 39,600. Share premium, it was 3,300. Share premium was 33. I believe you can understand ordinary from the purchase, from the compensation. Compensation was 33. Then we issued rights issue. Rights issue. It was 66. Then share premium was 33. Therefore, don't ask me where are you getting 33 and 66. This was from the issue, purchase consideration. Then this one we issued as the rights issue. We separated the premium. We separated the premium. Then we go to non-current liabilities. Under this, we have 8% bond. 8% bond was 11. Sorry, before we go to current liabilities, sorry, we have equity component. We have equity component. Equity component of 622. Equity component of 622. That equity component, 622. Then we come to non-current. %8 bond, which is 11,878. We separated. You remember we separated. Then we come to current liabilities. Under current liabilities, when we check in the balance sheet, let's go to the balance sheet. we had accounts payable, accrued interest, bank overdraft. Interest and bank overdraft we paid. Payables is the one that we have not paid. Therefore, I say here, payables. Payables is 3090. 3090. Then I believe we are done. I believe we are done. You give me total equity and liabilities. That is what you are required to do to get your marks. That is what you are required to do to get your marks. Any question before we end this noble class? Any question before we end the class? That is our balance sheet. That's our balance sheet.
Mwalimu,
Yes.
under ordinary shares, you've stated that you have a total of the 33 that we got.
Yes.
The right issue is 6,000
Yes.
share premium. I'm also seeing you've also separated share premium.
Yes.
Down there.
Yes.
It already included under ordinary shares. How?
Yes. And remember, when you have shares at a premium, anything above the bar value, you don't mix. If you mix, you will fail. Always you separate the bar value and the premium. Like this one, we issued shares at shillings 15, but the bar value is shillings 10. Therefore, you are required to recognize the premium of shillings 5, and you must, remember Marie is using the word, you must separate. If, for example, I just report together, this figure will be wrong. That figure will be wrong, I will not get that mark. I need to separate the premium and the bar value always. Are we
It's okay, Mwalimu. Yes, I've understood. Asante.
Thank you very much. Now we meet tomorrow at 5 p.m. God willing, as we introduce group accounts. Thank you for today. Thank you for your time. Bye-bye. God bless you.